Don't put it all on one thing because anything can change. We're seeing like, you know, commercial real estate can change overnight. Like things can change. And as they do shift, we've got to be able to be very, very well diversified in what we invest in as we watch these things happen.
All right, folks, we're going to talk about the economy. And if you've been watching my channel for any length of time, you know that I've been calling for a slowdown for sure in Q4, probably started the last month of Q3. It's just been clear to me that people are pulling back, and we'll know for sure, I think, this week with retail sales. If retail sales go negative, it will be validation. But I just don't think the economy is nearly as strong as kind of some of these backward looking indicators are. But that said, rate cutting cycle, stocks at all time highs, cryptos now Bitcoin's at 66,000. So maybe this is the no landing and we're just going to keep ripping from here. What do you got on? What do you think?
Yeah, I doubt it. I've been saying I see deteriorating conditions for almost a year now. And it's been quite frankly surprising to me that we have not been, officially at a recession. And we get these data prints and the markets kind of hinge on one report and they go crazy or they kind of, go crazy up or down either way. And then, things kind of smooth out. But we've had a kind of a bull market in stocks for 2 years
Yep.
almost, but it's
2 year bull
interesting.
market. Yeah. Yep.
Yeah, it's definitely surprised me. I think there's a lot of things going on, that makes that happen. A lot of it's hope. Also, election years generally are actually a really good year for the stock market and it's usually right after the election, the next year that you start to kind of officially see the pain. And we've talked about before, I didn't think it was likely that the NBER would declare a recession before an election. They just don't want to appear to be political at all.
Mhm. Yeah.
But what I've come to understand, even more so this last couple of years than I did before, is just how many revisions come out. Like how much of the numbers that make headline are not actually even real numbers. They're calculated numbers and they're based upon surveys plus a calculation. And so oftentimes these numbers, even GDP prints, Michael, they can be revised 7 or 8 times up to a year and a half later. And if you go back to the Great Recession, for example, it wasn't declared for a year and a half after we were in it, right? And so just because a recession hasn't been declared doesn't mean that we're not there. And just because you have recessionary conditions doesn't mean you can't have a positive GDP print or 1 month when it looks like you've created jobs. And so what I see is more of the same. I was a little surprised, but I always then dig under the hood when I saw a positive CPI and GDP print. It's like, uh-oh, okay, here we go, right? And you and I've talked a lot about this. We don't really know for each recession what is it going to look like. None of them look exactly the same. Some seem to be quick, but they've actually been building up for a while and then they're suddenly declared and suddenly admitted to. Others are kind of rolling recessions. And you and I've said, for a while that this kind of looks like a rolling recession. We know, for example, manufacturing is in a recession. Trucking is in a recession. There's sectors of the economy that are in recession. And then there's a few other sectors of the economy that are really recession resilient, that are usually kind of the last to turn, that seem to still be doing well. And so when I looked at the last reports that everybody said, oh, wow, maybe we really have a soft landing or a no landing to your comment, I dug underneath the hood a little bit, and I have to give the economists credit. I listened to economists who are digging under the hood, and they're telling us here's what's really going on underneath all these numbers. And what we see is that with the CPI and with the jobs created, the most recent reports everyone got excited about, it was almost entirely healthcare and government jobs again. And it's kind of rhyming and reminding us of what we saw the first quarter of this year and the last quarter of last year was the jobs were by and large healthcare and government. And when that happens, when government and healthcare jobs make up, I think it's more than 10% of jobs created, it's always indicated you're in a recession. We had over 25% of the jobs in the last quarter of last year for a good job report that were government and healthcare. So yes, there's sectors of the economy that are doing well, and it's generally government and healthcare. Still some travel and vacation, which obviously we had a lot of that through August, when, kids were out of school. People tend to spend more money on eating out and vacations. We've talked about before, most people are actually putting that on credit card debt. So just because they spent money over the summer doesn't mean that you have a resilient consumer. And when it all comes down to it, what I look at, Michael, is where is the consumer, not where is the stock market. Because we already know it's only about a quarter of households that actually invest in the stock market. Those numbers kind of change from time to time outside of money market accounts. A lot of the stocks that have done really well have been the big the stocks that are in all these mutual funds. And so you've got mostly 401k investors and very wealthy investors investing in them. But if you look at the breadth of the stock market, it's not broad. It's a few companies and they're priced to perfection. So what I mean is the stock prices are betting on a no landing. And if you don't get a no landing, generally speaking, if we're in a recession, which I think that we are, it just hasn't been declared, the stock market generally corrects after that, after an election year, about 30%. So I just say we need to be careful. Don't say the S&P's, at record highs and therefore the economy's good. We had some jobs created and therefore the economy's good, because the consumer is really where GDP is. It's like 70% ballpark consumer spending. The consumer is stretched. Increase in bankruptcy cycles over the last 2 months, increase in small business bankruptcies, increase in credit card debt, decrease in household savings. So that can't last that long, Michael. So for me, I still see the economy getting worse. I still see the Fed cutting interest rates, although the CPI print was a little bit high. It was often in those things that we can't control the cost of, right? Healthcare, housing,
Yeah.
etc.
Yeah, I looked really at the CPI number and I dug into the housing number because that's the one that I just laugh at how it's calculated, right? Rolling
Yeah.
12 months. And it housing is posting at 4.9% in the last print. And because it has a large weighting, almost 33%, I think it's
Yeah.
32%. Because it's so bad, it disproportionately hurts CPI.
Yes.
I actually did back in the napkin math, trying to strip it out, just assuming rent was zero. And if that was true, right? Instead of 4.9, you made it zero, and the weighting is 32%. You actually get CPI under 1.
Yeah. Absolutely.
That
Housing
big
is a
of an
huge,
impact.
and a big piece of the housing has actually been insurance. And so insurance costs have literally doubled in many, many places around the country. And so that makes the cost of ownership, even though there's, generally lower interest rates overall, and most
Mhm.
people that own homes are locked into those, lower interest rates, the insurance costs and the taxes going up has really made it high, even if you don't have rent increases. But the other thing, Michael, is those numbers, again, OER, owner's equivalent rent, is a calculation and it lags real time. And so when these numbers lag real time, just like the rent does, just like GDP does, a lot of people don't understand that, let's go back to jobs, right? The jobs number is based on surveys, and it's surveys of small and large businesses. And they say, how many jobs did you create? And then they do this death birth model where they make a calculation on top of that to then come up with also what they think GDP is. So GDP isn't just money spent and this is, the net and this is our sales. It actually has a component that's calculated
Mm.
just like the jobs does, and just like owner's equivalent rent. And so if one number's off, like how many jobs were created, that impacts the GDP calculation, OER, impacts the CPI calculation. And so they just have these headlines, but then none of the local news media channels actually report the revisions when they're changed downward. And so what we see, just like on this most recent jobs report, so we've got CPI, to your point, calculated, it's a little off, it's a little lagging. You strip that out, and other than, housing, and most people aren't actually moving, CPI is actually coming down very close to that 2% inflation, but people are freaking out that we're going to have another dip of inflation that the Fed got it wrong. And so now there's going to be no cuts in November. And that's what some are saying. But if you really look at inflation, it really is coming down, other than those areas that the Fed has no control over with its rate cuts, like the cost of insurance and the cost of living. And the other thing is the private sector jobs, to the point of the job calculations, are actually negative again. So you've got public sector, healthcare, government, positive jobs, but there's job losses in the private sector, and there's reduced hours worked. So companies are cutting hours. And once companies start cutting hours, Michael, it's the first thing they do before they then start laying off. And so I think that all of these things is still coming to a head where you at least have a silent recession. And that's where
Yeah.
70% of the population, they have a personal recession going on. So the question is, and to your point, what are retail sales going to look like? The thing that you've got to realize, though, is what do people do when Christmas is coming up, Michael? They spend money. How do they spend it? They put it on
Credit.
credit cards, right?
Yeah.
And so you might still see some consumer spending and a good season because Americans keep saying the Fed's going to cut rates. It's going to get better. Let's just put it on our credit card and we'll kick the can down the road. We do the same thing the government does. We go into debt and we kick the can down the road. So I don't get excited by a consumer spending number, a CPI number, a job creation number. I think we have to look at the breadth of the economy and say, where's the consumer? Are they getting better or are they getting worse? And then what's the thing that's going to get us into the next expansion? Even if we have a soft landing or no landing, where is all the new spending going to come from? What sectors are going to continue to do well when the household is stretched? And I just don't see a big shining light of where we're going to get that big next expansion. So I still say, we've got some more softening coming, and I think it's going to be worse than what some people think. So we'll
I
see.
I got a couple of thoughts there. We're going to do
Yeah,
economy, and then we're gonna then I have an idea of where this next flush of cash was going to come from, but I'll do the
yeah.
economy first. One of the things that I am looking at the economy that I don't think we'll know for another 4 or 5 years is I actually think the US economy is going through a structural change where all of
Hmm.
the economic models are going to have to be revised because the economy we had before 2020 is dead and gone. And the economy we have post 2024 is just different. What do I mean by that? I just think there is more solopreneurs, more gig working, more part-time jobs. I think it's a, I don't, I just think the economy might have, more entrepreneurs, more, I just really do think, the office, the 40, work 40 hours for 40 years at one place and get the gold watch. That was already dying in 2020. I just think it's gone completely now. And the economy we have going forward is just different. And I'm not saying better or worse. It's just different. I'm not making a judgment call.
Right.
And I don't think any of the economists are acknowledging that because, when you look at the jobs market and you hear full-time employment jobs are off 1 million and part-time jobs are up 3 million.
Yes.
People look at that and they have an old lens. They're like, in the old world, we get to complain about the full time jobs being gone, but what if? Just what if we have a different economy?
Yeah.
And we don't manufacture anything. Let's bring manufacturing back. Maybe that'll happen. But I just think the structural labor market may fundamentally be different because of the pandemic and work from home and you know solopreneurs and all of these things.
Yeah.
What do you think
I
of that?
I think that's a really good point. And that's something that I've thought about, but I really haven't been able to find the numbers, like to dig into the numbers enough to say, is this a blip? Is this a temporary thing? Or is this a really a new normal, a new
Yeah,
paradigm? And
new
to
normal.
your
Yeah.
point, like so many people I know are doing DoorDash, right? They're doing Uber. And so I do think, I mean, it's very, very clear that people are having a hard time making ends meet. When we talk about the number, the ballpark, 70% of the population that's living check to
So let me
check.
let me push back on that because I know that number. We talk about it all the time.
Yeah,
But when I hear people say that,
yeah,
and this isn't a poke at you. I know you know this, but when
right.
when I hear people on Twitter or X, or they just start saying 70% of people today can't make ends meet. Well, what was that number a decade ago? What was it 15 years ago? It was really the
Yeah.
same freaking number. We're just bad at, households are bad at money management, right? I don't
Yeah.
think it's appreciably worse than a decade ago.
Well, appreciably no, but it has been consistently getting worse. That number, at least in
Okay.
the surveys that I'm seeing, the economists, that the macro people that I'm listening to that are, constantly getting these numbers. Since about the end of last year, households are more and more households are reporting that they're living check to check. Their
Hmm.
savings is coming down from where it was before.
Sure.
So
Sure.
granted, there's periods of time, are you comparing it to right after everybody got, money, helicopter money after COVID?
Mhm.
It's going to look significantly worse. But you and I've done, the math and we've gone back and
Oh, yeah.
looked. And the reality is inflation makes most people's cost of living, they're flat. So if you go back and you look at, managerial jobs and
Hmm.
hourly workers, what they made in the late 1970s, they're essentially making the same
Yep.
exact money today. It's just that on an inflation adjusted basis, right? And
Correct.
so,
Yeah.
yes, households are basically staying flat and staying afloat. But the fact of the matter is, as the cost of living from inflation has gone up 25% ballpark within
Yeah.
that range for most households, okay, in the last 4 years, and wages have not kept up with that number, it
Totally
is
agree.
definitely getting worse, right? So, not how appreciably, I don't know, to your point, because
Yeah.
I haven't gone back and looked at all the years, but household savings, people are reporting that they can't. You see old people, I told you last week, old
Yeah.
people going back and getting work, getting jobs because they can't live on their social security anymore. So I
It's
think the,
funny.
the consumer is
Yeah.
definitely in a worse position and racking up more credit card debt at the same time. So that's not good. Even
No,
if it
it's
wasn't a
certainly
lot
not good.
better,
Yeah.
the question is, if okay, let's say I've got a gig economy. These are the questions in my head. I don't know the
Yeah.
answer to this, right? But we have a gig economy. Young people are taking on 2 and 3 jobs. I just talked to a high school student that graduated last year. I said, "Hey, what are you doing?" He's like, "Oh, I'm working here and I'm about to take on a second job at UPS so that I can work a lot more and I can cover my truck payment, right? The full-time job isn't enough." So it's like, okay, now they're going to take on 2 jobs. I see the 80-year-old woman ballpark sacking groceries, going back to work. Even if I've got people taking on second jobs to make ends meet, if I'm trying to go out there and now create a new job, create a business, right? If 70% of the population is check to check, their credit card is maxed out, they don't have savings left, no business that's discretionary that's created is going to do really well. So it's going to be harder in my estimation, at least until things change, until we get wages back up and we have another expansion period. Until that period, I think small businesses that start are more likely to fail than they were before. And 95% of businesses fail in the first few years. It doesn't mean young people won't try, but you've got to kind of say, who is the target audience that still can spend money, that still has discretionary money to spend? And then I think businesses that target those that can continue to spend, because there will all be a segment of the population, the 20 or 30% that do have money that will spend and will keep the economy afloat. What does that do structurally? How does that impact inflation and CPI? It's really hard to tell. The other thing that I think, to the point of the structural changes, is we've talked about this again, not making it a political issue, even though it's very much a political hot bucket, right? Hot button right now is immigration. We've had 6 million immigrants come in the last 2 years. And so they are spending money, they are working. And in some of these numbers that we've seen and jobs created, they're actually creating more jobs. So we've had more jobs go to immigrants, and the net difference is a decrease in jobs for Americans that have been here. And again, that's a political point on some sides. But the fact of the matter is we do have 6 million more people here working and spending. And that can keep the economy going
Mhm.
structurally different, even though some of those jobs aren't reported. They're underreported jobs. It's underreported spending. And so that could be a big shift as well if we really start to bring more people here. That can actually be a boost to the economy and spending as well. That there's not a lot of economists talking about, is that a structural change? Are we going to have
Mhm.
more of that happening? And how does that impact, to your point, the models? And we just don't know.
Yeah. So on the other thing on the labor front that I'm seeing, Wall Street Journal just did an article on this. I think it was Sunday. It might have been yesterday. I think it was Sunday, talking about the next six-figure career being. I think it was. I think they highlighted air conditioning and you know, uh, just the trades. Basically, it
Probably
was
plumbing and
push.
electrical.
Yeah,
Yeah.
plumbing and electrical. Basically, kids don't go to school. Go pick up a trade. And that's something I've been saying for years. I think there's a very good chance that that becomes the Gen Z millennial career path, right? Go work in the trades. I mean, I've said this before, but when I look at my Rolodex of people I use in my market of Fresno, California, all but one are over 50. A couple of them
Yeah.
are over 60, right? They're not going to be doing this forever. So I think there's a huge void, air pocket in the trades where Gen Z
Yes.
doesn't have to sign up for the 4-year college debt. They could start working at 18 under somebody, and by the time they're 22, 23, be making six figures, right? So I think
Absolutely.
there's more good ahead if we choose to see it. I just think the economy is
Yes.
changing. It's just changing.
Yes. Yeah, and that's a really good point. I mean, we talk about the reality is we're in kind of a funk of a business cycle. We're kind of in
Yep,
this funk where it's like, how long is this going to last before something changes? And so,
agreed.
it isn't comfortable for a lot of people, but we do realize that these things go in cycles. And so it's not that it's going to stay this way forever. It's that things will change. You'll probably hit a bottom, a recession, then typically once you do, then you start to expand. And some expansions last longer than others. Some seem to really get going, fast and furiously, and others are like a slow grow. Post GFC, it was actually slow growth. It took
For
several
years, yeah.
years to really start seeing that. But then, everything started booming again. And so you always have to look at that with enough optimism to say, we can't be totally fatalistic. Like, could the world fall apart? Yes. Would it be bad for all of us? Yes. But in the meantime, where can you find those pockets of growth? And as investors, we really want to go, where do we see those things happening, right? Where do we see a lot of construction? Where do we see a lot of the trades who there aren't a lot of people in those states or in those cities replacing them? And that's a big issue with the trades. There's not enough young people right now doing it. But if they see, hey, I can make this much money without going to college, you might see more and more do that as colleges get more and more expensive. And so, where can we find those pockets of growth and then invest there? Whether you're investing in stocks and you want to say, okay, we see growth in construction and healthcare, so let's go invest there, or AI or tech or whatever it is. You also want to look at, and this is really important for real estate investors, where are those companies and jobs going? Where are their local GDPs that even if the US GDP isn't great for a couple of years, where are those local markets that are really thriving, that are still bringing jobs, that are still bringing people, that have a lot of young people coming? Because they're the ones that are generally more innovative and really start up the next thing is these younger generations. And so I want to go to cities like Dallas, like Raleigh, like Phoenix, where we see a lot of jobs coming, parts of Atlanta, parts of Houston. I'm sure there's, certain towns in California that I'm not, that aren't on my radar right now. But you look at those pockets and you say, I want to invest there because that's where the growth is coming. So we definitely need to watch, Michael, to your point, for these shifts and these, every I don't know, 30, 40 years, you have some big shift, the industrial revolution, the tech era, the modern like we've got all of these times when things really do shift because hard times end up breeding innovation. And so we've got to be optimistic about that.
Yeah. And then back to something we talked about earlier, where could the money come for the second or the continued wave? I'm actually looking at homeowners equity,
Yeah.
right? There's, I don't know what
Yeah.
it is, 30 trillion there. John Burns Real
Yes.
Estate Consulting just put out something this morning that shocked me. The average, so this isn't the median, it's the average. The average homeowners equity today, 400 grand.
Wow.
400 grand. Now that's obviously skewed because of California, New York,
Absolutely.
all of that. So
Absolutely.
what I did is I said, okay, if average is 400, let's call median 200. And that's just a guess. It's
Yeah.
certainly going to be lower than 400. I'm like, what if rates start trickling down and by this time next year, they're 5.5?
Hmm.
I simply ask myself, when does mom and dad tap that equity?
Right.
When does mom and dad tap that 100 grand? Because I mean, history says they're going to at some point.
Yeah.
Now, the question is, what do they do with that 100 grand? Do they pay off credit cards? If they have them, I hope so. Right? Is it a debt management? Is it a is it education? I mean, what are they gonna they're gonna add an addition on their house, right? What I mean, there's 66% of us own a home. That's just the
Right.
numbers.
Right.
40% are free. I mean, there's so much equity out there that if rates come down low enough, and I think 5.5 is kind of the number, maybe that's 26. I don't know, but it's sometime out there. The question I have is, when does mom and dad tap that equity? What do you think?
Right. Yeah, it's hard to know, right? It really is without looking kind of regionally and by age group. I do know, for example, baby boomers have the most wealth of any generation. And as baby boomers start to die, unfortunately, they start to downsize, they start to gift, their children and their grandchildren money. There is going to be a big windfall for a lot of people, just from that as well as what's in their home equity. And the more people I think the more people that are not living check to check, like if they're already living check to check, even if they've got equity, they might have a hard time tapping it if their payment's going to go up, right? If they've got equity and they've got really good, they don't have debt, they don't have credit card debt, and they're not living check to check, I think it's going to disproportionately help the people that aren't living check to check. So I'm just thinking like, okay, if 70% of the population's living check to check, doesn't have 500, $1,000 saved, they might not even qualify for a home equity loan. So they're going to have to sell their house in order to get that equity. But for that 30%, why not tap the equity? The question is going to be, compared to that 5.5% rate that you mentioned, where can I go get 7, 8, 10% on my money in a safe way? Because most people that are going to tap equity, they're not going to go invest that in the stock market, because the stock market is somewhat more volatile and risky.
Mm-hmm.
So the question is the economy giving you stuff? If you're going to tap equity, you're going to do one of two things. You're going to pay down debt, right? Or you're going to go invest in something, a business, stocks, whatever. Most of what I've seen historically is they're not putting it in the stock market. So you've got to have at least a humming enough economy for people to go spend and invest that money. If people already have a lot of equity and they're doing well, they'll spend more. So that can stimulate the economy a little bit. But I think a lot of it's going to be paying down debt, people that are going to have to pay down debt. And if they can, their credit cards and their auto payments are more expensive than that home equity loan would be, which it might be. I think they pay off debt. The question remains to be seen in my mind, how much does that really stimulate the economy? How many of those people are really spending the money versus paying down debt?
Well,
I just
yeah,
don't know
yeah.
the answer to that, right?
Well, again, I think we both study the consumer long enough. Let's just pretend it's 50-50. 50, you know, go invest it, add an addition to the house, whatever it is. The other 50 pays down debt. The reality, again, about just the average person being average is, even if they pay down the debt, their payments go down. They go down for a minute. I mean, how many people will be charging on those cards, a
They
month
will.
after it's paid off? And then
Yeah,
is consumption. The
true,
relevering up is consumption.
true. Yeah, and that's the question is does the consumer fundamentally, their world's kind of been rocked for the last 4.5 years, right? Do they fundamentally back off and say, we kind of look back 10 years and that's how people think the next 10 are going to look like
Mhm,
the last 10?
mhm.
If they've been so rocked over the last four, those that have, the question is, do they have a 4 or 5 year period where they're just too scared to spend any more money? And I think
Yeah.
that those that are more educated might be, but I think that those that are already living check to check, I grew up in poverty mentality. We did a video on this. They're going to self-medicate and still spend, and they're just going to hope that things are going to get better. So, yes, I mean, we know all these things, but how do we extrapolate that to say, this is where I think the boom's going to come over the next 3 years, right? Where will they spend money?
Yeah.
What area of the economy will it be in? What areas of the country will it be in? will more people migrate? Will political stuff make people migrate, again? It's really hard to tell. These macroeconomists try to get it right, but it's very difficult. So, I think we have to your point, recognize that people are people. We are a consumer society. We're a society used to debt, and people learn from that or they don't, And so I it's all fun to think about, but I just don't know how I quantify it into an investment decision other than to say, follow GDP, look at where areas are doing really well, invest there, and always have hope that things are going to be better. Don't give up and think, don't be fatalistic. Keep investing and just watch as times shift, right? Who would have thought, railroad would change things and electricity would change things and the internet would change things, like, and people can do anything from anywhere now. So that fundamentally has really changed even since COVID. Like,
Mm.
even companies that didn't want to do work from home, so many are now. And those that are trying to get them to come back, they're losing a lot of people, right? So lots of fundamental changes. It's kind of exciting to watch. I think we just can't bet the farm, right? It's like I tell my
Mm.
son when he's investing in stocks, like, don't bet the farm. Don't put it all on one thing because anything can change. We're seeing, like, you know, commercial real estate can change overnight. Like, things can change. And as they do shift, we've got to be able to be very, very well diversified in what we invest in as we watch these things happen.
I guess I want to see where we are as we look at our broken crystal ball. So what do you think the chances are sometime between today and January 1st, 26? So all of this year, all of next year, from 0 to 100%, we have an unemployment rate 5 or higher. What do you think?
We're at what today? 4.3 still?
I think 4.2 or 4.3. I think it went down to 4.2.
I believe we probably have an 80% chance of getting to 5% or higher in the next year and 3 months.
Yeah, so I would give it. I'll definitely go below that. I'll say 5%. That's. I'll go.
5%.
Yeah. No. I'm just saying in my head that's the number. So I'll say 50%. So
Oh,
I'll
okay. Yeah.
yeah, 50%. We have a number of 5% or higher.
Yeah.
So 80%. So let me go 5.5% unemployment sometime in the next 15 months.
Maybe 60% chance.
Oh, see,
It's
I'll go.
hard to tell because we have
Yeah.
so much immigration coming in. And
Yeah.
that's the number that is,
Yeah.
even though we're technically higher than that in the private sector unemployment, okay, for US citizens. Those increased 6 million jobs has kept that number just higher. And that's why this historically low unemployment rate
Mhm.
is impacted by immigration
No. Yeah.
significantly, right? And so, but the fact that we already have negative private sector jobs, when you strip out healthcare and government jobs, which is very recession resilient, and this always happens pre-recession. And then once the numbers go negative private sector, once you start having the big layoff cycle, you're already seeing the bankruptcy cycle, you're already seeing negative full-time jobs in the private sector. That gets worse, usually precipitously
Sure.
worse once a recession is declared. So I'm still going to say 65% chance we hit 5.5% in the next year and 3 months. I don't think it'll stay there long, but I still think it's a higher probability than most based on where I
Yeah.
see the details of the job data already and the increases in corporate bankruptcies.
Yeah. So I'll go 10%. Again, we're
Oh, 10%
different.
unemployment.
No. 10% chance we're
Oh,
at
okay.
5.5 or greater.
Yeah.
Um, okay. So let's do GDP. Do you think we have any quarter, just one quarter of negative GDP print, Q3, Q4, or the next year? So the next 6 quarters. Do you think we get a negative quarter?
I think this is a harder number to
Ah.
guess because it is manipulated. When you hire enough government jobs and healthcare jobs, it keeps GDP positive,
Mhm.
even though the private sector is in the negative. We saw that at the end of last year, early this year. It
Mhm.
is the thing that kept us from technically going into negative quarters of GDP. So from that perspective, no, I believe both parties that are up for election at this point have shown in their budget projections more increased government debt and spending, right?
Yes,
So
like $2
we're
trillion or something
we're going to
crazy.
have more government debt and more government spending, no matter who's in office, both sides, right? That is the reality. And if they continue to spend in areas that are going to prop up GDP to keep us from having a recession declared on their watch, or for, to keep stimulating the economy, that can keep GDP positive just barely, as long as they keep spending money. And the reality is, if you go back and look even before COVID, and I've talked a little bit about this, I've done some big presentations on this, but historically, demographically, we've not produced enough GDP by the population and production. So the government spends more and more to keep GDP just above inflation. Their goal is 2% inflation because they know they can't get GDP much above 2.5%, 3%. And that's with a lot of government spending. So as the population declines, the government continues to spend more money to keep GDP just above inflation because they like inflation. So we've always relied, the last 40 years, we've relied on a lot of government spending to keep GDP just positive. I think that continues. So that tells me that it's very possible that we don't see 2 quarters of negative GDP, because the government's getting better, in air quotes, of spending money to keep that from happening, right? On the other side, I will just say this: GDI, gross domestic income, is very not looked at enough, and it should equal GDP. The gap between GDP and GDI has been almost 4%
Mm.
recently. And that means that the GDP produced is not actually coming into national and corporate and personal savings. So the numbers are skewed. Why aren't they equal? Anytime there's been this big of a gap, you've had significant bottom, depression, deep recession, which brings GDP down to catch up with GDI. So those two things together make me kind of say 50-50. If I was looking at GDI, I would say 80% chance we have a recession with 2 negative quarters of GDP. But because of all the government spending, Michael, I think that pushes that number back down, because I think that they're going to try to keep us from having a recession declared, even if it's a very flat, stagnating, stagflation, rolling recession kind of economy. I'm going to say 50-50 for those two
Yeah.
reasons.
Yeah. I think, I'm at the kind of the 20% level that we have a negative print. And I think if we have a negative,
20%.
yeah,
So you think soft landing? You
I've
think we're
always,
here at a soft or no landing?
I call it a rolling recession, not to split hairs, but again, I think there's certainly segments of the economy in a recession. I just think there's
Yeah.
enough, and again, some of that's government spending, to be clear. But
Yeah.
yeah, I think if we do have a negative quarter, it's going to be Q4. I think this quarter
Mhm.
we're in could be a negative quarter for sure. Q4 could be negative. I really believe that.
Yeah.
And
Yeah.
um, we'll see retail sales. Although I think retail sales are going to be for September. So yeah, it won't be for Q4. But
Right.
I'm very concerned about Q4. If we're going to have a negative one,
Yeah.
it'll be Q4. I think.
Yeah. Or
I mean,
even
how?
Q1 of next year. Yeah.
Yeah, Q4,
I
Q1.
definitely have much higher probability that the economy goes into a technical recession than you do, but the government spending is the big
Wild
wild
card.
card. Yeah.
All right, let's do the last one. A second bout of inflation. And I'll put the number CPI headline at, let's say, what do you think the chances are it goes above 3.5? I think the last print was 2.3. What are the chances it goes above 3.5 sometime in the
Very,
next
very
15 months?
unlikely. Very,
Yeah.
very unlikely. The only thing that would make me change that is if war escalates. If
Yeah.
we're
World
drawn
War
into
Three.
a deeper
Yeah.
war, or China goes after Taiwan, which they just made an anniversary celebration and basically said
We're
we
coming.
want to reunify, right? So if we have deeper war, we're sucked into a bigger war, with Iran over Israel or with China, inflation will come back with a vengeance, because every, international trade will be on standstill. We'll be spending so much money. We'll have to pay higher treasury rates.
For sure.
And war is very inflationary. So, if we took that off the table, I would say
Yeah.
almost 0% chance that we go to 3.5. But if those things happen, it could come back very, very quickly.
Yeah, let's all put good karma out there. No, no,
Yeah.
no war, no World War III, none of that
I don't
stuff.
believe in the power of my words. We're not calling for World War III, trust me.
Yeah, yeah, that's not what we want. So yeah, I agree with you. I think the chances we get back to 3.5% is pretty unlikely.
Yeah.
You know, X World War III. So, and so
Yeah.
I guess if I were to kind of summarize where you're at is you're definitely preparing, or you've been preparing for a rough year, right? The next
Yeah.
15 minutes are going to be, or 15 months are going to be rough. Um, but again, rough times are where people make hay, they make their best deals, right? You
Yes.
pivot, it's where you deploy capital, right? When everybody
Right.
runs away. So,
Right.
um, and then I just see a sideways, no fun, almost 1970s yuck economy. Just
Yeah. Well, here's the thing. We're not so far apart. I think that we will have more unemployment. I think that that's coming. The consumer, I think, is tapped out. So I think we will have a recession, um, probably declared, but again, we'll see depending on the government spending. I think that there's more pain ahead. However, my bigger concern, and it's like you, and I've been saying this for, on our show for over a year and a half now, Jamie Dimon saying like
mm,
stagflation is a concern. And again, it's
yeah,
not that CPI has to go to 3.5%, but the things that consumers spend the most money on, which is their housing, their insurance, their healthcare, and their food, right?
yep,
Some of those things are in CPI, food is not, right? Some goods have come way down. So you've got enough things in GDP, in inflation that are coming down, but you've
mhm,
got other things that are going way up, like insurance and healthcare, et cetera. So you could have a inflation that hits households that is more so than you have income and wage growth or GDP,
for sure.
and that keeps the economy very flat. I've said a flat decade. I see a flat decade, Michael. I'm not changing
Yeah,
my call on that. Now, hopefully, we're 2 years into that flat decade and we've only got 8 years left, but
right.
I just don't see anything in the next 8 years coming in with a bang enough to produce enough growth in the economy to counteract some of the inflationary pressures, not immediate inflation, not in the next year or two, but reshoring, wars, things like that. So I
Yeah,
see a very flat economy just like you do. And stagflation is the name for that. And we're very much kind of in a stagnating, stagflationary economy. It hasn't been called that yet, but I'm still in that camp that
yeah.
it may not get deep, deep bad. Like it may not be another GFC, but I think we're going to bottom out. We're going to hit whatever our trough is going to be, which is called a recession, no matter how
Mm.
deep or long that lasts. But I think then we have a very flat decade that's just going to take a lot of time to get the engines going until that next big thing comes to really create an expansion where our production and our wages are higher than the cost of living going up.
Yeah, I just don't see it's just gonna be yuck. It's gonna be
Yeah.
just a yuck economy.
Yeah.
Um,
The good
that's
news
what
though, Michael, is if we think further back than the last, 4 years, we had like
Mhm.
2 really amazing years. And then for commercial real estate, the last 2 years has been hard, right? It just has been hard. Making cash flow and even residential has been a little harder, right? But
Mhm.
but the stock market's boomed. But here's the thing. After the GFC, the first few years were very hard. And we had a very slow recovery. Although we had the longest expansion period in history, it wasn't a huge expansion for
Yep,
most of
yep.
the economy. It was a very slow growth, yet people made significant amounts of money. If we look at the US economy and GDP over the last 40 years, it's actually been deflationary. We've had low growth, right? Low wages have been flat since the end of the 1970s on an inflation adjusted basis. But look how much money we've been able to as Americans create over the last 40 years. A lot. So
Mhm.
even if the economy, here's I think the rosy part of this, even if the economy is on a downward slow decline or it's very, very flat, there's always opportunity. We live in a capitalist society, a free society. There's always opportunity to make money and to do well. You just have to say where, given
Mhm.
how things are, Where can I make money today? And then go invest your time and learn it and do it. And real estate is a human need. We're always going to need real estate. I believe in real estate. I think we're always going to make money. Even in the next 10 years, I plan to make a lot of money even if the economy is very, very flat. So we talk about these things to say, let's put on our reality. Let's balance the great news with the sky is falling news with some reality of how things could go. But we always have opportunity. And I think we always will if we keep that mindset of, hey, the economy as a whole might not do great, but I see, hey, um, maybe we buy an HVAC company, right? Maybe we go buy a home improvement company. I mean, who knows? But there's
Right.
opportunity for all of us in every economy, despite the fact that our economy as a whole has been kind of on a decline. It's still better than most of the world's economies, and there's
There
still
you
a lot
go.
of opportunity, right?
Where can people find you?
You can find me here on your show each week. You can find me on social media at Anna Kelly, REI Mom. And for real estate coaching and consulting, you can find me at annakellyinvesting.com.
Thank you so much.
Thank you.